And welcome. My name is Zato. I'm the Managing Principal here at Sharrock Pittman Legal, and thank you very much for joining us for our webinar today, focusing on land tax and stamp duty changes here in Victoria. Before we get started, we would like to acknowledge the Wurundjeri people of the Kulin Nation as the traditional owners of the land on which our office is located, and we pay our respects to their elders past, present and emerging, and we extend this respect to all First Nations communities throughout Victoria and wherever you may be logging in from. So whether you have joined us before for one of these webinars or not, a very big welcome. We hope these webinars, which we put on regularly, are a helpful resource for you in your businesses or organisations to get some must-know information and guidance on different topics that we think will be of interest for you. So you can catch up on recordings and slides for our previous webinars by heading to our website and clicking the link for the resources page. And you'll find webinars on all the different topics that our lawyers have presented on in commercial and business law, disputes, estate planning, employment law, and of course, property law, including the series last year presented by the team on commercial and retail leasing issues. But today we're going to look at a different area of property law, and one that's been in the news a bit and causing a bit of angst out there, which is land tax assessments coming in and going up, of course, causing quite significant impacts out there. So a lot of changes and more to come. So we're going to cover that a bit today. And I'll shortly hand over to Andre, who will start taking us through today's content. Andre is a principal here at Sharrock Pittman Legal and an accredited specialist in property law. And he has many years of experience in this area and advises our customers on these sorts of issues all the time. Now he's looking forward to sharing his knowledge today, as are Shuba, Ignatius and Crystal from our property team. So just a couple of housekeeping items. We are recording the session. It will be on our website soon after this morning. So if there's anything you miss, you can catch up with it later, but also feel free to get in touch with the team. We'll put everyone's contact details up at the end of the webinar. If you do have any questions along the way, please feel free to type away in the Q&A box. We'll try to get through questions as we go, but we are conscious of time. We've allowed some time at the end for more questions, but if we do have to wrap things up and we're conscious of your time, we will get back to you on any questions that we aren't able to get to before the end of the hour. So before we get into the nitty-gritty of things, we are lawyers after all, so forgive us for some fine print, but obviously we can only give you some general guidance today. Everyone's circumstances are different, so it's really important to keep that in mind when you're thinking about your own situation. Make sure you do get some specific advice before doing anything that you may need to do. So now to get started, I will hand over to Andre, who will start taking us through today's content. Thank you, Andre.
Thank you very much, Mitch. Hello, everyone. My name's Andre Young. I'm an accredited property law specialist and the head of our property law team here. So before we get started with the depth of everything, I just thought I'd provide you with some preliminary thoughts on really the shifting landscape in property taxes in Victoria. There's a very active move announced a lot in last year's budget to transition the tax mix and lean heavily against the property sector in terms of state taxes, and from a Victorian government perspective, recovering some of that debt that was, or a lot of that debt that was incurred through the COVID years. And that's definitely being done, or the heavy lifting's being done through the property sector. It is just the new tax environment we're all going to have to live with, unfortunately, whether we're residential property owners or commercial industrial property owners. It's just the revenue mix being adjusted by the government, and ultimately those state services have to be funded somehow, and this is really what the government's doubling down on. The rising property values, especially in the industrial sector, has really underpinned all of that, and the government, as I will go through at the very end of the session, in terms of the transition from stamp duty to a new commercial industrial property tax, there's certainly that transition in the tax mix where the government is looking at moving away from, I guess, the fluctuations that occur within the stamp duty revenue take to something a bit more stable and arguably growing aggressively in terms of land taxes based against property values in the state, especially in that commercial industrial sector. But as with any tax, it is having a very large impact on both owners and tenants alike, because it is ultimately a cost that has to go out the door, and the money has to get sourced from somewhere. So I just thought I'd quote a couple of interesting numbers that have come across my desk from the Southeast Melbourne Manufacturing Alliance, of which we are members. They've conducted a survey of their membership 2024 to assess really the impact of this rapid increase in land tax bills that people are seeing. And there's certainly a strong correlation strong recognition of the rapid escalation of those land tax bills. It's not a steady year on year. It is more of an exponential growth in those land tax bills. Obviously hit this year from the fact that a lot of the tax thresholds have lowered, so ultimately resulting in larger tax bills. But even prior to that, especially in the industrial sector, the growing values have really underpinned a rising tax take, and the government is doubling down on that. And that's an increasing cost for all of the members of SEMA, and obviously all businesses throughout Victoria at increasing levels. Within that survey, they noted, 74% of their members are saying, well, the prices of their businesses will have to rise to cover that additional cost. 68% have said that they can't invest in new equipment because of that additional impost. 47%, nearly half, couldn't hire additional qualified staff to meet the demand in their businesses because of that cost. 37% couldn't hire new apprentices or trainees. So again, impacting the future of those businesses. So this tax shift, as much as it is obviously allowing the government to recover some of those debts, is having a very real economic impact. So running on to today, if we could run on to the next slide, we'll have different aspects covered off, primarily in relation to land tax, because that's really where the government is doubling down. So Ignatius Suwanto will go through the elements and operation of land tax in a general sense. Then Crystal Roman will go through the new reforms in the vacant residential land tax that were announced in the budget last year and then legislated in December. So one of the last things the state government passed into law at the end of last year, and already having an impact. Then Shubha Rao will run through what are the structures in terms of your ownership that will affect land tax, and what might you want to consider if you're going to shift some of those structures. And then I'll round off the session in terms of the reform to stamp duty and land tax in relation to commercial and industrial property. So there is that move, as I said, away from stamp duty into land tax mode, which will commence from 1 July this year, and I'll raise some issues there. So I will hand over to Ignatius Suwanto to start our session.
Thanks, Andre. Now I'll touch on what is land tax. Land tax is an annual tax based on the total taxable value on all the land you own in Victoria. It is calculated based on the site value as determined by the Valuer General in Victoria of all taxable land you own as at midnight 31st December of the preceding year of assessment. So you own a land, what you get is a land tax assessment. Next, there are a few different assessments that you can get, and you can have more than one based on your circumstances. The first is the individual assessment. If you own a land on your own, you will get a land tax on that property. Next, joint assessment is a bit more complicated because each individual joint ownership is treated as differently. So for example, if the individual is A owns a land with B, and A owns a land with C, A can get 3 assessments, one for A owns individual land, and 1 assessment for A and B, and the third one for A and C. And the third one is trust assessment because there is a trust charge on the land tax. So if A is also a trustee for a trust, A can get another different assessment for the trust itself. And the last one, which is a bit more complicated, is the land tax grouping, which means that for corporations which are grouped, the land tax of each corporation of the group are combined and assessed as if they are a single land holding owned by a single corporation. So what it means if three company 1, 2, and 3 owns different property, but they are all controlled by A. These three companies are going to be assessed as one because they are treated as one group. So what's the factor of determining whether these companies are a group or not is whether the control of the board of directors lies within a certain company or a certain person. 2 is the voting power in the company, and third is the shareholding in the company itself. Next, in the assessment itself, you will usually receive the details, like 1 is your customer number, assessment number, total payable, taxable value, and also the statement of lands. In the statement of lands, you will have the list of all the properties you own and the taxable value of each individual property. It is a bit confusing in the sense the SRO listed both the single holding assessment and also the proportional assessment. The single holding number is not the number that you actually paid. The single holding means like if that property is your only property, how much land tax is accrued by that property. The proportional land tax, because like the land tax system is a progressive tax, is like how much that property contributes to your total assessment of land tax. Next, I'll move on to general exemption. So you receive land tax, what can you do? First, check if it's exempt or not. Generally speaking, your home is exempt under principal place of residence. If you use the property for farming as your business, it can be exempt. My colleague Shuba will touch on that one. And another exemption, which is more niche, is if the property is used as rooming houses or any other charitable institution use. Now, if the property is not exempt, can you recover the land tax from the tenant? Because like usually you accrue land tax on your investment property, and that property might be tenanted. Unfortunately, most of the time the answer is no, because like one, on the Retail Lease Act, it prevents the recovery of land tax from any retail lease. I put down the section there, section 50. And the Land Tax Act itself deals with the recovery from a residential agreement, which is section 99. So any provision that seeks to recover land tax from the tenant is deemed to be void. So the only time you may be able to recover land tax from your lease is for a commercial, non-retail lease. And this is subject to the provision of the lease itself on whether land tax is recoverable. And on this note, I'm touching very briefly, the amount that you can recover might be also subject to negotiation, because like generally we can see it's recovered on the single holding basis that I have touched on, or it can be also on the actual land tax assessed on the landlord. Next, I'll touch on the COVID debt repayment plan, which pretty much means that from 2024 onwards, the land tax rates are increased to recover the debt from the Victorian government. This applies as a surcharge. As you can see from the bracket, from taxable value of below 100,000, between 50,000 to 100,000, 500 flat surcharge apply, and between 100,000 to 300,000 or 250 for trust, flat surcharge of $975 applies, and above that, a flat surcharge of $975 plus an increased rate of land tax of 0.1 percentage point. Just to mention this briefly, this doesn't mean an additional increase in the land tax itself as by way of a surcharge, because like this is incorporated in the land tax rate table itself. So if we move to the next slide, we can see that this has been incorporated into the SRO land tax general rates. As you can see, the bracket has changed from last year. The minimum taxable value of land that attracts land tax now decreased to between 50,000 to 100,000 or 500, and the percentage points of land tax also increases due to the COVID debt repayment plan. And this also applies on the land tax with trust surcharge. In the next slide, so we can see that the COVID debt repayment has been incorporated as flat surcharge, and also the increase in the percentage point for each bracket above 250,000. Next, I'll give an example of how land tax actually works, because there's confusion on between single holding and proportional tax. As you can see from the table previously, land tax is progressive tax, so the more land you own, the higher the tax rate for the whole properties. So for the example, you own 3 properties identical with 1 million taxable value of land. So in your land tax assessment, you will receive the statement of lands listing all 3 properties. And under each property, it will say single holding land tax of 4,650. This is not the amount you pay for each property. This means that if you only have 1 property, you will pay 4,650. But because you own 3 properties, your total taxable value of land is 3 million, and the total land tax payable is 31,650, which means each property worth 1 million in your hand worth 10,550 for each property. Similarly, this also applies for company grouping. If there is 3 company 1, 2, and 3, each own the $1 million property, if the shareholders are all different, they are all going to pay the single holding because it's the only property that the company owns. But if company A, B, and C are owned by one shareholder that controls all the 3 companies, they are grouped together, and the total estimated land tax payable will be 31,650, and the proportional tax will apply accordingly. Next, I'll touch briefly on the absentee owner surcharge. So this is an additional land tax that applies for individuals that are not Australian citizen or PR, or does not reside in Australia, or either absent in Australia on the 31st December or for longer than 6 months in total in the calendar year prior to the land tax year. What it basically means is it's drafted in a negative. So if you are an Australian citizen or PR, this doesn't apply to you. If you ordinarily reside in Australia, this doesn't apply to you. But if you are not those 2, you have to satisfy both. 1, you stay in Australia for more than 6 months, and you have to stay on Australia on the 31st December of prior to the land tax year changing. And similar requirements apply to a corporation in so far that if it is controlled by an absentee person with the same requirement, it will be deemed as absentee corporation, and additional surcharge is 4% of the taxable value. Now I'll pass the time to Crystal for the second residential land tax.
Thank you, Ignatius. So we'll be speaking about the vacant residential land tax. This tax was first introduced in 2018 and applied to homes located in 16 specific council areas in metropolitan Melbourne. In short, if a residential property remains vacant for more than 6 months in the previous calendar year, then the tax shall apply. For example, if your property, which is not a principal place of residence, remains vacant for more than 6 months in 2024, then you are obligated to pay the tax in 2025. So this is different to land tax, and it's also in addition to the land tax that you'd have on these properties as well. This property applies to residential property and land, and it's pretty much any property that is not your principal place of residence that remains vacant within the calendar year. So it also applies to vacant land that does not have a residential dwelling constructed if the land is capable of being used solely or primarily for residential purposes. Now let's go into what defines vacant. So a property is deemed to be vacant when it is not lived in for more than 6 months out of a calendar year. This 6-month period does not need to be consecutive. To classify as being lived in, it means that either the owner or a person under a lease or a short-term letting agreement lives in the property. The short-term letting agreement can be something such as Airbnb, for example. So the State Revenue Office also accepts that a property is occupied where the owner's permitted occupants, for example, a family member, uses the property as their principal place of residence. An example of this would be a father permitting his daughter to live in his investment property as her principal place of residence. However, a property will not be deemed to be occupied if the owner lets friends or family members reside in the property, and it is not that person's principal place of residence. So for example, this would be that an owner's friend or family member is visiting from out of town and is staying in the investment property for 2 weeks. Importantly, a lease or short-term letting arrangement must be made in good faith and not for the purpose of avoiding the tax. For avoidance of doubt, it's not enough that the property is ready to be lived in. This means that the property will be considered vacant even if the property is available to be rented off, let's say Airbnb, for the entire year. If it has not been occupied for at least 6 months, it will be considered vacant. So we'll go to the next slide. So there's been a lot of recent changes to the vacant residential land tax, and it has broadened who it actually affects now. So I'll go through some of these changes. Originally, the tax was introduced with the intent to encourage landowners to make residential properties available for purchase or rent. As mentioned, this tax was introduced to only 16 specific council areas in Metro Melbourne. The tax is now extended to include all of Victoria. This obviously creates an issue for many property owners who have purchased properties in regional Victoria as holiday homes and now need to be mindful of this tax. A lot of these owners hold these properties in their trusts or companies and may not be able to access the relevant exemptions. And some of these properties that are in regional Victoria sometimes are mainly used for short-term letting agreements such as Airbnb, and therefore it might be difficult to secure 6 months of occupation. So another change that is new is a progressive rate of the tax will apply to non-exempt vacant residential land based on the number of consecutive years the land has been liable for the tax. I'll go into this in a moment. Another change or an update is that in respect of the holiday home exemption, from 1 January 2025, the holiday home exemption will be amended to enable the occupation requirement to be satisfied by a relative of the owner. Currently, the requirement has been by the owner themselves. It's a bit unclear how the State Revenue Office will satisfy itself of this and whether the SRO will request some kind of evidence or documentation to satisfy that the occupant was actually a relative of the owner. From 1 January 2025, there will also be a new exemption for new residential premises to be extended to allow a maximum exemption period of 3 years, provided that the owner has made a genuine and reasonable efforts to sell the land. If the property is not sold within these 3 years, the land will become liable for the tax at the rate of 1% until sold. Another change is that from 1 January 2026, the tax will apply to all unimproved residential land in metropolitan Melbourne that has remained undeveloped for at least 5 years, and it's land that is capable of becoming residential land. So with this change, there are new exemptions that will come into effect as well, one being the exemption will be introduced for unimproved residential land that is contiguous to a principal place of residence, And another exemption is that unimproved land that is incapable of being used or developed for residential purposes. I'll go to the next slide. So how is the tax calculated? The tax is calculated on the capital improved value of the property. If you have read through one of your council rates notice, you will see that you have two values listed there, site value and a capital improved value. The site value is what is used to assess land tax, and that is the value of the land without any improvements. The capital improved value is the value of the land and capital improvements on the property. So the capital improvements can include the building, shed, whatever has been done to improve the land on that and the property on that land. And this is determined by the State Revenue Office general valuation process. So obviously sometimes the capital improved value is larger than the site value. The tax is an annual tax of 1% of the capital improved value. So if your property is valued at $1 million, then the tax is $10,000 for that year. As mentioned earlier, one of the significant changes to the tax is that there is now an increase in the applicable rate of the tax if the property is vacant for more than one consecutive year. If the property is vacant for 1 year, then 1% tax shall apply for that year. If the property is vacant for 2 consecutive years, 2% tax shall apply for that second year. If the property is vacant for 3 consecutive years, then 3% of land tax will apply to that third year. Now, if the property remains vacant for more than 3 consecutive years, tax will continue to apply at 3%. Obviously, if your capital improved value on your property increases, the amount of tax payable will also increase that year. Now, let's talk about what are the notification obligations. Affected landowners are required to notify the Commissioner of State Revenue of any vacant residential land owned by 15 January of that relevant tax year. So for example, if the property is vacant in 2024, the landowner must notify the State Revenue Office by 15 January 2025. So there is a positive obligation on the landowner to notify the State Revenue Office. You may likely not get a reminder bill like you would for the land tax payment, and it's on you as the landowner to keep an accurate account of how many days the property is occupied or remains vacant during the calendar year. So this is also particularly important if there's an audit on the property and you need to show that the property was occupied for more than 6 months. The State Revenue Office is also launching a trial to enforce the tax rather than relying on self-reporting. So it was announced that the Victorian government will launch a trial to enforce the vacant residential land tax across metropolitan Melbourne, starting with apartment towers in 2024 and expanding to inner and middle suburbs in 2025. So this means that the State Revenue Office can utilise data such as electricity and water usage to identify homes that are vacant. If the State Revenue Office does audit a property using this method, then the landowner is required to show that the property was occupied. Again, if your property is used for short-term letting arrangements such as Airbnb, make sure you keep an accurate record of each stay because they can be quite far apart. Now, there are a few exemptions to the tax, and I'll go through that now. So firstly is the holiday home exemption. The holiday home exemption applies to landowners who hold their property in their individual capacity, and it doesn't apply to companies or trusts. This exemption may be available if the land is used and occupied by the owner as their holiday home for at least 4 weeks in the preceding calendar year. This 4 weeks does not need to be consecutive. This exemption does not apply to land held in a company or discretionary trust. The Victorian Government has indicated that it may seek to pass legislation to provide relief in respect of holiday homes that are held in these structures, but there is no current draft or any further discussion at this time. Again, if you qualify for this holiday home exemption, you need to maintain a record of when you use the property in the calendar year to ensure that you meet the exemption thresholds. The Commissioner for State Revenue must also be satisfied that the property was a genuine holiday home, taking into consideration the owner's actual home and distance to the holiday home, as well as the frequency and nature of its use. For example, if the landowner lives in Richmond and they have an investment property in Mentone, will the Commissioner of State Revenue consider that a 15-kilometre distance from your principal place of residence qualifies as a holiday home? As mentioned previously, the new changes mean that a relative of the landowner, again in the individual capacity, can meet the holiday home exemption requirements. As I mentioned, it's still unclear how the State Revenue Office will satisfy itself of this. One of the questions is being that who is a relative. Obviously, we think of spouses, parents, children, siblings, will aunts, cousins, grandparents also apply. Our next exemption is the work accommodation exemption. So again, this exemption applies to owners holding the land in their individual capacity. This exemption applies to property used and occupied by the owner for work purposes only. For example, the owner of an inner Melbourne CBD townhouse lives in Mildura and uses their townhouse in the CBD when they are there for the purpose of their work. For this exemption to apply, the property must be occupied by the owner for at least 140 days of the year. So that's roughly over 4 months. And it must be for the purpose of attending their workplace. There are a few other exemptions that apply. So number one being where land that becomes residential land during a calendar year is not subject to the tax for up to 2 years. This tax applies only where the land has not been used or occupied. So this exemption applies only where the land has not been used or occupied and the ownership remains unchanged. For example, think about a warehouse that is converted and developed into residential apartments in 2024. The apartments remain unsold and therefore are exempt for 2025 and 2026 calendar years. Another exemption is if a property is undergoing renovations and it's unable to be occupied, the property will be exempt from the tax for 2 years from the date that the building permit for the construction or renovation is issued. Obviously, if you can't live in the property, that means that it's substantial renovations or construction. So the renovation must be substantial enough that a building permit is required for this exemption to apply. If a property changes ownership during a year, it will not be subject to the tax. So the change of ownership must actually occur during that year, being that settlement occurs in 2024, let's say. Now, there are a few considerations that landowners or buyers need to make now when buying property. If you intend to purchase an investment property anywhere in Victoria, there's obviously greater considerations to bear in mind now, especially if you're looking more so at regional properties. Firstly, the obvious question is whether buying in a trust structure is appropriate for your intended use of the property. Because, as I mentioned, the holiday home exemption and workplace exemption will not apply. So you'll need to be sure that you can fulfill the occupation requirement if you are purchasing as a trust or in a company name. If you intend that the property shall be used as a holiday home and you have no intention of leasing it out, you will only be able to receive the holiday home exemption if you hold it in your individual capacity. So consider whether this is appropriate and suitable for you. If you do intend to purchase an investment home to be used as both your holiday home and also as a short-term letting arrangement, such as listing it on Airbnb, you don't want to hold it in your own capacity, you will likely need to enter a lot more short-term letting arrangements. So be mindful of the capacity to do that. So importantly, if you purchase in a company entity and you do not meet the required 6 months of occupation, the SRO is strict in its occupation requirement, and we are unaware of any ability to have the SRO move the needle a little bit in that respect. Now, the most important thing to remember is what you do with your investment property in 2024 will determine whether the tax will be payable come 15 January 2025. So it's only the start of the year, and there might be a lot of time for you to put in place leases, short-term letting arrangements, or agreements or other arrangements as necessary. And as I mentioned before, it is extremely important that you keep an accurate record whenever the property is being used and occupied, so that when it comes to 15 January, you can accurately record that the property was occupied. I'll pass it on to Shuba now.
Thank you, Crystal. Just the previous slide, Mitch. Good morning, everyone. So I'll be discussing some of the general land tax exemptions and concessions and what actions, immediate and future planning wise, can be undertaken once land tax assessment has been received. There are a couple of land tax exemptions that can be claimed, as Ignatius mentioned in his section. However, we will be focusing on the following exemption and concessions, which are for primary production land, principal place of residence where there's trust structures involved, and also in terms of nomination of unit holders in a unit trust scheme, or nomination of a beneficiary in a fixed trust structure that's there. Next slide, please. So with the primary production land exemption, we first have to sort of determine what is primary production land. So primary production land is land that is used primarily for primary production, or solely for, or primarily for the business of primary production. And it also includes land that is being prepared for primary production. In terms of the eligibility, next slide, please, Mitch. So what is primary production there to be eligible for this exemption? The Land Tax Act defines primary production as cultivation for the purposes of selling the produce of cultivation, whether in a natural, processed, or converted state, or the maintenance of animals or poultry for the purpose of selling them or their natural increase or bodily produce. Keeping of bees for the purposes of selling their honey, or commercial fishing, including the preparation for commercial fishing, or the storage or preservation of fish or fishing gear. And lastly, the cultivation or propagation for sale of plants, seedlings, mushrooms, or orchids. So it is limited in terms of what primary production relates to. Next slide, Mitch. Another eligibility criteria is where your land is located as well. The location of the land will determine the different types of criteria that are applied for you to satisfy to claim that particular exemption. So the three areas that the SRO will look at, the first one is whether the land that's being used for the activity is contained wholly outside of the Greater Melbourne area. The second category is whether the land is wholly or partly within the Greater Melbourne area, but not in an urban zone. And the last category is whether the land is wholly or partly within Greater Melbourne and wholly or partly within an urban zone. The SRO website does have a map of what is considered to be Greater Melbourne and urban zones, and we've just provided the link there for you to be able to access that if you wish. So in terms of accessing the eligibility for the exemption, there are various revenue rulings that the SRO has released, which provide some guidance as to whether that eligibility is actually applicable to yourselves or not. As a disclaimer, the revenue rulings do not actually have force of law, and so are not binding on the State Revenue Office, but it is an indication of how they actually do interpret the legislation that's out there. So in terms of the Land Tax Act. So with respect to land that is wholly or outside of Greater Melbourne, or land that is wholly or partly within Greater Melbourne, but not within an urban zone. So it's basically land that's caught by Section 65 and 66 of the Land Tax Act. The criteria that we need to look at is whether the actual activity that's being undertaken on the land is actually the primary use of the land. And what does primary use actually mean? So we actually need to look at the actual and physical use of the land. Inactivity can also be considered if this is a means to obtain an advantage from the land. The activities must have a certain degree of intensity and substance. So it cannot be something that's minimal that's not consistent in nature, and can't be token or slight. So you do actually have to look at the type of activity that's being undertaken on the property. The other criteria is the purpose of selling. This is the reason for this. The reason for the primary production activity being undertaken must be determined. There must be an intention of sale of the products for that's being undertaken on the land. Activities for recreational personal benefit will not qualify for this exemption. Another one is if there is secondary production that's being undertaken on the land as well. So this is where the primary produce is converted or processed into derivative items. Land that is used for such secondary production activities or for the retail sale of products derived from secondary production are not eligible for the exemption as well. So it is limited to only primary production activity. If there are multiple lands used in the activity, each land must be separately assessed to determine whether it is possible for the scenario of eligibility to apply for each parcel of land that's there. In terms of timing, the activity that must be undertaken should have been undertaken for the last 6 months prior to the 31st of December assessment date that's there. There is discretion for the SRO to look at a shorter time frame or a longer time frame for that, but 6 months is the general rule of thumb. And for the land that's under Section 65, there is a partial exemption available. So if there are multiple uses on the land, the part of the land that's used for primary production can be eligible for an exemption there. With respect to land that is wholly or partly within Greater Melbourne and within an urban zone, so Section 67 of the Land Tax Act, the revenue ruling LTA number 11 does apply to this one. And so the criteria that we need to look at here is a bit more detailed than the previous one. It has to be for the sole or primary use for the business of primary production. So this introduction of the word business extends what work literally needs to be done and the intention for the primary production activity. So we have to look at the nature and extent of the activities that are undertaken on the property and the purpose of the activities. There must be a business element or characteristic, such as a profit-making intention and the prospect, size, scale, and the permanency of the activity. Is there a business plan that's in place? Systems for operating day-to-day in terms of running the actual activity there, and evidence of sales that are being undertaken. So this would be specific for every single property because it's a question of fact and the degree of activity that's actually being undertaken there. Because of the use of the word business there, hobby farms and adjustments would usually not be considered as eligible activities there. This particular criteria as well is another one in terms of how the land is owned. The State Revenue Office has different, if the land is owned in individual basis or a trust basis or a company structure. The State Revenue Office does have identified different persons or entities which are required to be engaged in substantially full-time capacity in the principal business of the landowner. So there needs to be someone who is actually undertaking such farming, primary production type of activity that's actually there. So there are a couple of additional layers in terms of trying to seek eligibility under this particular ruling for Section 67 of the Land Tax Act. If you could go to the next one, Mitch. So in terms of the primary production land, there's also, the SRO does recognize that there is possibility for doing preparatory work to build a land up for primary production usage in future. So this relates to Section 68 of the Land Tax Act. In terms of the preparatory type of activities, they must be continuous, consistent, and an unbroken effort. And it must form part of the process for the future primary production activity. So if you're sort of just clearing land in terms of control of weed or anything like that, that's not going to be eligible for this particular future exemption that's there. In terms of the time frame, you're given 12 months from the commencement of such preparatory work for the land to then be able to be used for primary production purposes there. So you would need to ensure that this particular time frame is actually met, or again, you will not be eligible for this exemption. If you can go to the next slide, Mitch. So what do we actually do if in terms of the other concession that you so this is not an exemption, it's a concession that can be obtained. So if the property is owned under discretionary trust, a unit trust scheme, they can actually nominate a principal place of residence beneficiary. The beneficiary must be a natural person, and there can be only one nominee at a time. The trust can make one nomination at a time. And a nomination form must be completed with the SRO. So in terms of the PPR beneficiary, they must use the particular residence as their main residence there. And generally, they should actually be using that property as their main residence from the period from at least 1st July to 31st of December for the previous year. There are an exemption to that if the trust purchased the property during that period. So in the later half of the year, the trust purchased the property, there is an exemption for that. But otherwise, a period of at least 6 months needs to be covered there. With regards to the nomination form that gets lodged, it applies for the year that it's been lodged. So it's not retrospective there, but we will carry forward into the future land tax assessments that are assessed. So the impact on land tax by doing this nomination is that the trustees are assessed on the land used by the PPR beneficiary as though it's the only land that's used by the trustee and at general rates. And the land is exempt for PPR, for the PPR beneficiary, and so they will not be assessed on it at an individual rate. So the overall land tax that's applicable would be lower. Similarly, if a property is owned under a fixed trust or a unit trust scheme, the trustee can nominate unit holders and the relevant and beneficiaries under the trust as well to seek to reduce the land tax surcharge that may apply. And similar to the other one, a nomination form must be completed with the SRO as well. So when nominating a unit trust, you'd have to identify all the unit holders in the trust, and similarly for the beneficiaries as well. So what is the impact of land tax if a nomination is done? The trustees are assessed on the land at general rates. The trust land is deemed to be owned by the unit holder or the beneficiary that is nominated, and will be assessed on an aggregated basis if that particular beneficiary or unit holder has other land holdings there. And there will also be a tax deduction in terms of what the trust is paying under its assessment there. So in overall, there should be a reduction in the land tax that's actually payable there. The trustee must, with respect to unit trusts, so unit trust is able to actually nominate the PPR beneficiary, or they can nominate the unit holders under the trust as well. So, but it's only one of the options that the unit trust can actually exercise, and it can't do both. Slide, Mitch. So what do you actually do? So if none of those exemptions or concessions can apply to your situation, then what are your options when you receive a land tax assessment? So an objection can be made with respect to either the site value or the capital improved value that has been applied in a land tax assessment. So usually the land tax will be on site value. So you would look at that amount and you would think whether that's reasonable or not for your property. Any objections must be lodged within 60 days of you or your representative receiving the assessments from the SRO. A failure to do so within these timeframes means that the Commissioner has the discretion to reject your obligation, and the assessment stands. Any late obligation that's submitted as well should put in the reasons for why the objection has been put in late for the Commissioner's consideration. Any objection must also include detailed reasons as to why it's being asserted that the valuations are incorrect. So ideally in that process, you would have then obtained valuation from a valuer as well to determine the land value, the site value that's there, and put that forward to the SRO. Next slide, please. In terms of the future planning that's there, so there probably needs to be an assessment of all the structures in terms of how the properties are being held. If Ignatius mentioned with respect to the grouping, if there are trusts or companies that are related, so they have similar, they have identical shareholders or they have identical beneficiaries, but they're just named trust 1, 2, 3, and 4. Or companies, just different company names, the SRO can apply the aggregation principles, and the properties are all treated as though they're being held under the same entity. And so the land tax threshold increases, and the higher land tax, the threshold, the range that the land tax charge will then fall into the higher one that's there. So that's just something to watch out for and consider whether it is worth spending, I guess, money up front in terms of setting up different structures that are unrelated to each other, so that each structure is then treated as holding the land on a single holding basis and not the proportional basis that's there. Another option that's available when you're looking at trust scenarios is to whether the property that's held under the trust are then distributed to beneficiaries under the trust. Generally, there are no stamp duty consequences for such trust transfers if the beneficiaries were have always been beneficiaries of trust or have always been unit holders at the time the particular property was acquired, and if there's sort of no consideration paid for the transfer that's there. If there's any loans or mortgages that the trusts are holding, then that needs to be addressed, and there is a component that can address those issues in terms of refinancing of those loans and so on. So that's possibility there in terms of trying to look at the different structures and go, what's the most commercially viable application there? I'll now hand over to Andre.
Thank you very much, Shuba. So I'm just going to run through the new tax that's being introduced in terms of the commercial and industrial property tax. This hasn't quite kicked off yet. It is intended to commence from 1 July 2024 for your next transaction. It will only apply to commercial and industrial property, not to residential or primary production land. And this is an additional tax. It's in addition to the land tax liability that already exists, and it will bring into play, as I said at the very start, that transition from stamp duty revenue being where the state's getting its primary cut of property-related taxes to land tax-based revenue, because this tax will be introduced at a rate of 1% of the total unimproved value of the land, no tax-free threshold, so just a straight 1% of the assessed value. And as we're all aware, industrial land values have really escalated over the past year, so that's another impost that's going to go straight over the top. There is, in effect, a 10-year transition period. So the idea of this is that for your next transaction after 1 July 2024, that will basically be the last stamp duty that is paid on that property. And then that starts a clock running 10 years from that point. It will transition to this new tax, and that 1% in commercial industrial property tax will apply. So something to consider then from 1 July this year, and bearing in mind this presently isn't legislated. It was announced in the budget last year with not that much detail, and then on the 11th of December, there was an information sheet published in the Treasury Department. So if you want more details on it, there's a few pages on it there, but that's basically it at this point. So jumping onto some of that detail. So post 1 July 2024, you purchase an industrial property, you then have a choice to make. You can decide to pay that one last stamp duty, and in the normal way, you just pay it from your own funds as you do now, but the 10-year clock will start running, and 10 years from that point, this new tax will apply to your property. Alternatively, there is a transitional government stamp duty loan that you can also obtain or apply for if you meet certain criteria. The criteria essentially are that you're an Australian citizen, permanent residence, you're an Australian business, the property value is up to 30 million, and you've been approved for financing from an authorised deposit-taking institution or approved lender. So essentially a bank that the SRO will approve. Again, there's not much detail on that at this point. That loan will basically have a fixed interest rate. Again, not much detail on it now. It's intended to be a market rate based off the Victorian Treasury bond rate plus a commercial risk margin. Further information is intended to be released this year, but again hasn't been released as yet. And whilst you're paying off that loan in those fixed payments, just be aware that if you sell the property or want to pay that off early, there will be a break fee that is intended to apply. So the government is factoring in that interest into its revenue base. So this transition, once you're into the new system and you're paying your additional commercial industrial property land tax, that will basically continue as long as that property continues with its commercial industrial use. So that use is defined using the valuation codes, basically 200, 300, 400s, and 600s in the standard valuation code list. But they'd be covering off shops and all the usual industrial warehousing, etc., all the usual industrial commercial property you would expect. There is a bit of a nuance to it where you have a mixed-use property. Say you've got a shop with a residence above it. Then will this new tax apply? So there, the SRO is going to look at a sole or primary use test of the property. So say in that shop and upstairs residence example, the shop and the storage areas behind it are the primary use of the property, it would normally fall within the system, and that new tax would apply for the whole value of the property, regardless of that residence at the top, unless that residence at the top is used by the owner of the property as a principal place of residence, because there is an exemption where the SRO will proportionalize the additional tax if a separate land tax exemption will apply. So if that use, as I said, is as a residence and as a principal place of residence where land tax exemption would apply, then that commercial industrial property tax is going to be proportionalized out just to the value of the commercial component of the land and be reduced that way. Again, all of this is preliminary information at this point, still on its way through the system, and obviously we'll see what the final version holds. Once you are in the stamp duty loan and that 10 years is running, just be aware that that is your obligation alone. If you decide to transact with the property, that loan will get repaid, noting the break fee earlier. That loan will be repaid as part of the sale. No stamp duty will apply in that further sale because, again, that stamp duty in that contract, that deal past 1 July is the last stamp duty that's paid. In any subsequent deal, no stamp duty will apply, but the new person's in the new system, and obviously the additional tax will apply to them. When you're dealing with fractional interest, that's another thing that the SRO is looking at with respect to this. So at the moment, the threshold is any dealings with land over 50% of the land will be considered as if it was dealing with 100% of the land, and pushes you into this new system as well. One final point here, as we're just running out of time, is that this will be an additional tax. It will not be able to be passed on to a retail tenant. There is intended in the information released so far, there is an intention to ban it from being able to be claimed from a retail tenant in the Retail Leases Act, as land tax is currently banned from being claimed from a retail tenant. Open-ended question as to what's to happen to this tax for a commercial tenant, bearing in mind that at the moment, leases in a commercial sense only refer to land tax. They obviously don't refer to this commercial industrial property tax. So something to consider there going forward, but obviously there'll be more out once the legislation is issued at some point this year. So as we run out of time there, Mitch, I think we might be out of time for questions. I have been answering them as we've gone along, so hopefully people have had a chance to have a look at that.
Thanks, Andre. I'm aware of, we have run a bit over time, everyone. So if you do need to jump off, that's fine. We do have two final questions, which might be quite quick to get through. So it might, if you want to stay on the webinar for a few more minutes, feel free. But yeah, we do have run out of time for any more questions, so feel free to contact Andre or the team directly if you have any further questions. But Andre, if the principal place of residence is in joint names and your holiday home is in joint names, could each spouse claim one property each as their PPR? I think this is a question we get quite frequently, isn't it?
Yes, it is. And unfortunately, the SRO don't quite let you off that easily in that situation where you've got, unless you're separated or in some way divorced, leading your separate lives, and you can assert that fact to the SRO. If you're a couple, only one of those places will be your primary residence, assuming you're living together for that. Crystal did go through earlier exemptions available if you are relocating for work purposes and that sort of thing. So there are some options that way, but unfortunately, in your average scenario, it's just going to be, you will be exempt for your home, your principal place of residence that you actually reside in most of the year, and the other property, although you will pay your standard land tax on it, you won't pay the vacant residential land tax as long as you use it for those 4 weeks or more.
And going back to discretionary trusts and principal place of residence, the question is about whether once a beneficiary is nominated, a PPR beneficiary, the trustee will then be assessed and exempted. Is that correct? I don't think that's quite correct.
No, that isn't quite correct. What will happen is that there will be an exemption of the trust surcharge. So it will be reduced, and Shiv had gone through that earlier. It will be land taxed at a reduced rate, but unfortunately, there will still be land tax.
And from my perspective in commercial law and succession planning and estate planning, I often get asked about asset protection and should we put the house in a trust and so on. And the short answer is, well, yes, you can, but there will be land tax to pay as a result, because you will no longer be owning the property, your residence in your name. It will no longer be exempt. You may be able to get it reduced, as Andre and Shiva have explained, but owning a residence in a trust is generally not a great idea from that point of view.
Absolutely, Mitch. So I'll just answer this question from Mark Tan just on the commercial industrial tax, because that is new and something for people to consider. So if you are buying new commercial or industrial property after 1 July, yes, it will be something you'll have to factor in, that you will end up being, as the purchaser, the last person to pay stamp duty on that property. And then the 10-year clock runs, where if you're still holding that property 10 years after that point, then you will also be paying the commercial industrial tax, property tax on top of that. So you end up bearing both of those liabilities, arguably, or thinking about it another way, if you use the transitional loan scheme, you end up spreading out your stamp duty over 10 years, and then at the end of those 10 years, you end up paying the higher 1% additional land tax effectively after that.
Right. One final question for me, but I'm not sure who this is from, but to do with different multiple people on title, where some people own other properties and some don't. That might be one for that person to get on to you direct, Andre, or do you
No, I can answer that very briefly. Usually in that sort of scenario, it does depend a little bit on the value of the property, because if you're underneath the thresholds, if the value of the property is low and it's underneath the thresholds, then the people who don't own other property won't get a land tax bill. And the people who do own property will just have their share of that property added to their land tax bill, so added to the total value of land they hold and what the proportional tax will be calculated as. Because the thresholds have dropped so much with the COVID repayment plan in the last year's budget, a lot of those co-owners will receive land tax bills for the first time, possibly this year, as the government is getting that repayment through, and those bills will be at the minimum threshold, which is $975.
Thanks very much
Right.
for the questions, everybody. We'll put up the team's contact details shortly. But as you can see on the screen, do check out the website if you want to catch up on what we've covered today, but also read some of the articles the team have put together on other issues you might be encountering in relation to property law in particular. And we do have a webinar coming up in a couple of months on the topic of employment law and side hustles and moonlighting. Saw something else on the TV about it just the other day. So definitely a live issue as people are doing things from home. So tune in for that with myself and Samuel, who's our workplace relations law specialist. Finally, just a quick plug for David Sharrock's book, Fighting for Enterprise Success Through the Eye of the Tiger, if you're interested in looking at ways of maximising the ways of systemizing your organisation or business and towards achieving enterprise success, then I do recommend that in ebook or hard copy. So check out the website there if that's of interest to you. And finally, just to wrap up, thank you again for attending. Apologies that we've run a little bit over time, but I'm sure you'd agree there's a lot of detail and nitty-gritty to get through in this sort of area and very technical. So do get in touch with the team if you do have any questions from time to time. I'm sure they won't mind hearing from you. And in the meantime, that brings us to the end. So thank you for joining us once again. And in the meantime, we wish you a good day. Thank you. Bye.